Hello YouTube! Today we're going to be talking about oil and how it is currently breaking out. It is now up by 3.5% on the week and it is over its 50 weekly moving average. This is really important because as energy prices go up, it usually does not do well for the economy. We can also note that zooming out here to CL1, which is going to be the light sweet crude futures, we can know we are forming a massive pot and handle, similar to a cup and handle. And this is a breakout pattern. So if this starts going higher, it means that the cost for energy is going to keep going higher. The reason why I find this so interesting today is because as we look over here to another chart, which is the DAX has been giving a lot of leading indicators to us, which means that it's been moving ahead of the S&P. And if we look here, we note that we are now back below our 2018 and our 2020 tops. We are below our 200 weekly moving average, and we are also below our 50 daily moving average. So what does this mean? It means it looks like there's going to be a deep, dark winter in Europe, possibly a deep recession, as energy costs continue to go higher. The reason why this is also particularly interesting is because when we look here to the 10-year note, and we have a look over to the 2-year note, we have a very similar pattern setting up here, just like we do on the dollar. What do we have? Massive cup, massive handle, back above the 50 MA. This is generally not going to be good. We can also note that the 10-year note is now back above 3%. And that is very notable. It's notable because John Taylor from the Taylor Rule was actually saying that the Fed fund futures rate needs to be at 5%, which is almost twice as high as we are right now. If we look at two more charts, we'll understand the story a lot better. Then we'll look at SPY and we'll look at QQQ to get a better understanding of how the broader market is doing. So the 2-year note definitely got ahead and completed its cup and handle already. We note that it's now bounced and it's right near the highs. So this exact same pattern is forming here. Weekly chart is a little bit more evident here. Here we go. So if you look here, there's our top, there's the breakout, there's our cup and handle where we, again, come down, come up, form our cup and handle, and then bounce up to go back up to the highs. We also have a golden cross like we're seeing on most of the other charts we just looked at. One more chart to look at here is going to be the dollar. So if we look here to the dollar, what do we have? Well, we have a W. It's not the same thing as a cup and handle, but this generally means a win. And the dollar is still green on the week. Part of the reason why this is so important is because when we look to the why bull or why bear thesis that I have, what we can notice that the things that we just reviewed, the DXY, the TNX, are the exact things we do not want to see if we are bullish on stocks. We can also note that deep recession risk, well, this could be a deep global recession risk, which could what? Have contagion back to the US, where the US might get dragged down because we're seeing softness in Asia and we're also seeing softness in Europe. If you look forward to the one data point which actually moved the market today, it's US new home sales, and they plummet to the slowest pace since early 2016. Ironically, the same level we're at in China. We're seeing current home buying at roughly 2016 levels. So what does this mean? It means we're seeing a slowdown. And as we shift here to looking to Jerome Powell coming in on Friday, the question is this evidence that he's going to point to say that this is what we want, we're getting what we want, or is he going to say it's not enough? I honestly do not know. But what I know is that the moves are getting more muted. And what I mean by more muted is that when we now look here at SPY on the one-day chart, we can note that we have pretty much, actually, there's one more thing I want to point out here. I kind of forgot about it. So if you look at the daily candle, which is forming here on SPY, and we keep in mind what we just looked at on the DAX, it is now below the 200 weekly. It is below the 50 daily. It is also below the 2018 and 2020 tops. If we now look at the daily candle that we formed today, what is it? Oh no, it's an inverted hammer. Yep. So we power slam down here to the 50 DMA. We gap down, pump up, sell off. And now we look at SPY. What did we do? We gap down, pump up, sell off, but we closed lower than we opened, which means we have a solid red candle. This is starting to feed through to more negativity. The reason why this is important for me is if you look back to our low that we set in June, we note that there's only been one other time when we had 3 red days in a row. So again, since we carved out our bottom here, we have 1, 2, 3 right here. There are other red days, but they are hollow, which means that we closed higher than we opened. Other than that, we've only been putting in 2 red days. So 2 red days lower, and now we got 3. This is looking like, again, there could be more downside because the last time we had more than 3 goes all the way back to our big power slam. And we left what? A gap on the chart. just like we did here. There's a gap on the chart. There's the second gap on the chart. So what does this mean? It means we're starting to see some evidence that the bears are flexing, not just in the US, but around the world. So again, I don't know where we're going to go. I know I've been saying that on the videos a little bit lately, and that's just because as we are now getting post-OPEX, which is roughly $2 trillion, let's go over the evidence here. So we got a $2 trillion expiry. We're now seeing, right, what's happening after the post-OPEX cuck is what I like to call that. So generally, if we did not even have the FOMC, if we didn't have the Jackson Hole meeting coming on Friday, what normally happens, keyword being normally, if the goal is for us to go higher into the next 30 days, they want to have this move down so that they're able to accumulate the underlying, meaning the stock, before they allow it to go in the money. Because what options mean is that you are getting exposure to an asset. So if you buy SPY calls, the market maker is forced to buy the underlying, which means they're forced to buy SPY. You buy an SPY contract, they have to go buy 100 shares of SPY. Why? To make sure they don't blow up. That's how it works. They collect the premium and they make sure that if they're going to go in the money, that they're allowed they're going to allow that to happen because now they are not going to be offside. They collect the premium, they let it go in the money, and everything's gravy. The other reason why this is particularly interesting is because if we look here, again, now that we know that we got the gap, okay, cool. Where are we also? Oh, no, we're also all the way back to our pink box. So we're back to the area where we had consolidation, and now we're falling right back down to that area. So with a daily gap on the chart, but also a daily gap on the weekly, we have not seen that since when? Oh, no, since we formed the bottom. That's the exact same thing I'm looking at here. So removing all the trend lines, what we notice that on the weekly chart, it is rare to have gaps. So on SPY, there are gaps here. Our gap is here going back to our low, which got established, and also our low right now. Does this mean that we're going to reverse from here, just like we did last time? 2 big red weeks with a gap down, and then we go up. So the reason why I'm calling this out is because we can now note that we have a technical dip off the top, or we're pretty close. We got down to 411.77. So from a relative high down to where we are now, we are down by roughly 4.6%. I'm going to call it 5%. We get down to 410, that's going to be 5%. Over on QQQ, we're now down by, I think it's roughly 6% off the highs. Yeah, roughly 6% off the highs. So advanced by 20+%, declined by 5. What is that? 20 steps forward, 5 steps back. What's a little bit concerning, though, is when we look here to QQQ, we know we have a big green line, which should be support. And if we look over here to what we're doing now, yesterday we gapped down exactly to the level. Yesterday's open is 318.5. I'm looking at 318.52. So it's within 2 cents, and we gapped down in flush. And then today we printed a lower low and a lower high, which means that it doesn't look like we're going to be able to fill that gap until we get the catalyst on Friday from Jerome. So with tech currently leading, it looks like it wants to go down. If you look here to SPY versus QQQ, we also note that they're really synced up here. We note that SPY is at 412.3, QQQ is at 314.1. They're off by roughly $2. They're getting really close to each other, but S&P is actually down more than QQQ today. One more interesting thing that I noted is I was looking here to try to understand what the market's doing. Again, instead of trying to tell the market what it's doing, we want to read it to understand what the story is. And when I look here, we can note that if we look at the monthly chart, we note we have an inverted hammer. What does that mean? It means we went up and now we came all the way back down. What's really important for me is going to be last month's high, or the July high. And the reason why is because that's at 413.03. We were hovering around there for a large part of the day, but we did close below. So all this means is that we are now equally as bullish as we were at the height in July or at the close of the month. And if we can't hold it, this inverted hammer usually leads to more downside. Not that it's a guarantee, but it's very ominous. Last thing I want to look at here is SPY on the 30-day chart. And again, I'm choosing the 30-day chart on purpose because we note that we've gone a whole bunch of nowhere. S&P is down by 64 cents in the last 30 days. However, when we look here at the heat map, and we look at the last roughly 30 days or the last month, there is clearly rotation happening. So we can note that tech is up, healthcare is down, commercial services are down, like credit cards. We note that other blocks are mixed, like consumer services, communications, and consumer durables. But now, if we look at the last year to date, what is going to, oh man, like everything's red. Yep. So everything's red except for energy, A little bit of healthcare, a little bit of consumer durable, utilities and healthcare services. This looks very similar to what has been happening on the last 1 week, where it's almost energy that's green, and where we are down less is healthcare and transportation. And all this means is that, again, to smooth it out, there is a rotation happening in the market. So when we look at the blocks here for the last month or the last 30 days, and again, remembering that S&P's pretty much gone nowhere. What I like about this in terms of the bull case is that what I would expect to see is leadership from big tech. Amazon up 7, Tesla up 7, Amazon up 7, Microsoft and Google up 4 and 2. However, on the shorter term or on the weekly, we are noticing some divergence, or again, the theme from year to date is now playing out on the 7-day rolling basis. So right now, we are deadlocked between the bulls and the bears, both having equal evidence in terms of us going into a new bull market or breaking above 430 and holding, or this could be it, where we now have our bear market rejection by getting a kiss of death on the 50 MA, leaving a gap, and that could be the flush just like we had in 2000 and 2008. So with that said, if you want to know more about what I just mentioned in detail, I encourage you to watch the video that'll come up here in a moment, which is going to be my weekend review, which talks about everything I saw over the weekend to get me prepared for the week. And I want to thank you very much for watching, and I look forward to seeing you tomorrow. Thanks so much.